Morning, everybody. Can you guys hear me? Good morning. Welcome to the PSG Summer update. I must admit, it's nice to see a full room. This is the last presentation for 2020, so it is great to see everybody in the room. Just 2022, thank you. Just a word of caution, we are currently being load shedded. The power will come back on probably at 12:30, so if it does come on during the presentation, please just bear with us. We have applied for CPD points. The presentation will be about an hour, so please just make sure that you scan out on your way out. And then I think just before I hand over to the presenters, I think there are some very important points that are going to be made in the presentation today. I mean, if you look at the inflection point in inflation and what's happened to that as a result in the government bond market, I mean, as you know, at PSG Asset Management, we've been long-term buyers of government bonds, which have, at attractive real yields, which have delivered substantially for our client portfolios at lower levels of risk. So today, we have Lyle Sankar and Ané Craig, and they're going to unpack some of the opportunities that we're currently finding in the market, and they're going to elaborate on how funds are positioned to exploit the current opportunity set. So as you know, we've got Lyle. He's head of fixed interest, and he's the lead fund manager of the PSG Diversified Income Fund and Income Fund. We also have Ané, who's got 7 years industry experience, and she's the assistant manager on the PSG Diversified Income Fund. So I'm now going to hand over to Lyle. Thank you.
Thank you, Tom, and thank you to everybody for attending. It's really great to be here. As Tom mentioned, it is our fixed income update, and what a year it's been for markets. So I think what I'll do is just take you through the items that we would like to cover. So, as you know, we are in a coordinated rate hiking cycle globally. Bond yields have risen, and risk assets in every market has fallen substantially this year. And so what we'll do over here is just take a walk through of what happened this year, try to make a bit of sense of the bond market, try to answer what is the big question out there is where do we go to from here for those yields? So the US bond market in particular we'll focus on. Is the pressure upwards? If the pressure is upwards, what pain can we still expect in the rest of the market? And so for 14 years, the bond market has not moved much since the GFC. And the bond market has made big moves this year. And so in our view, the bond market is alive. And that's going to set up a picture that's very different in the next 10 years. I know we'll spend some time in the middle of the presentation. Hopefully the load shedding event happens then. But the middle of the presentation will cover a theme that we carried through from last year. We think the winners of the past 10 years in a structurally higher inflation world will be quite different to the winners for the next 10 years. So she'll delve deeper into that, that key question, where to from here for yields. And we think particularly what we messaged last year is that commodity exporters are likely to do a lot better going forward. And as you can see over here, we think SA bonds are deeply mispriced. I'll then come back, wrap up the message. We'll talk about the PSG Diversified Income Fund, attractive income levels at low levels of risk, and then hopefully give you guys a solution to the markets that we're seeing going forward. So bond markets are alive. As we mentioned, we've seen this big move in bond yields up this year. So if you look at this chart, this is the US, Germany, and the UK's 10-year bond yield. And you can see these yields have been in a steady, slow grind downwards for many decades. So what that means is it's fantastic for bondholders. The bond yields are coming down. It's essentially a bond bull market. So this is fine. Bond 101, if there's no inflation, there's no fiscal risks, you're okay in those bonds, and you're happy to buy it as they are lower and lower. But as we saw this year, inflation has returned. And one of the key themes that we spoke about last year in this forum was that we felt structurally inflation was going to be higher and the market was getting it wrong. So the impact of that is that bond yields have now jumped. And that jump over there has been 3% up this year. So if you look at the long-term history, it doesn't look that much, right? It looks like a very mute move relative to where we are, in the 90s at 8% levels. But this has been the worst bond market performance since 1926. That small move upwards has damaged portfolios across the globe. So we think the bond markets are alive, and it's good to understand what drove it this year. So the first thing we'll talk about is inflation. We spoke about how inflation wasn't transitory. What we really want to focus on is getting the view on inflation wrong. So the market the central banks all showed a lot of complacency in inflation. There was an illusion of control over inflation. So if you go back to 2020 and 2021, I'm sure most of you will recall the conversation about inflation being transitory, the central banks focusing rather on stimulating economic recovery, so more support, rather than the central bank mandate of controlling inflation. So even if you go right to the beginning of 2022, the Fed still had the Fed funds rate at 0.25%. They were still buying 120 billion of bonds a month. So still quantitative easing, despite inflation at that point being at 7.9%. And so we think this has been the big shock to the market. And if you look at June 2022, Jerome Powell, probably the most influential person in financial markets today, makes a statement: we now understand how little we understand about inflation. And that's the core of this presentation, is that it's very scary when your central banker doesn't know, where inflation is going. And so what we've then seen subsequently is a sharp catch-up. We are in the fastest and steepest rate hiking cycle by the US in a very long time. So inflation caught them off guard, and inflation asks the first question of valuation. So on the second point, price matters. So when you look at the first graph, that's 200 years of bond yields in the US. So looking at the US 10-year, compiled by Bernstein. And if you look at it, right at the bottom there, we were in the lowest yielding bond market in history. And on the right-hand side, the most amount of negative yielding bonds that we've ever seen. So 18 trillion of bond yields below zero. So we've got an expensive market, and a market that you could easily put in bubble territory. So when valuation gets under question by inflation, and valuation has gone to such an extreme, it's natural to expect an outsized move in price, and we've seen that this year. But what valuation does when inflation comes through, it makes the market focus a little bit more, and this is where we think the bond market is alive. So high debt is not just an emerging market issue, and bond markets fund your debt. So the more debt you want, the more you have to lean into the bond market. Now, if you look at this chart over here, the darker the area, the higher the debt to GDP. And if you look at it, the US has got 125% debt to GDP, the UK at 95%, and Japan at 266% debt to GDP. Now, all of us in the room here have been taught and ingrained in us that emerging markets have a debt issue. But now with a bond market that's no longer a freebie for developed markets and inflation that's back, the market's now asking questions of that debt level. So the trajectory, and Ané will cover this later, is for more debt in developed markets. At a time when interest bills are higher, because the bond market is 3 to 4% higher in yield, we think this sets up a very precarious scenario. And the market has reacted to this. So the bond market will punish you for bad policy, and we call this a toxic cocktail: inflation, expensive valuations, and fiscal policy not moving in the right direction. So these low-risk, safe haven bonds have had a massive underperformance this year. US bonds down 38% year to date, and the gilts, the UK bonds, down 47%. For context, the MSCI world is down 24%. So the bond market, the safest place in the world, has had a worse year than the equity market. And what's worse is that a 60-40 portfolio, a typical asset allocation portfolio, 60% equities, 40% in bonds, would have had both equities and bonds falling at the same time. And that average portfolio is down almost 30 to 40% over the year to date. It's only happened 3 times in history since 1926. And 2022 is one of the worst years. So the bond market has punished these developed markets for poor policy, and inflation was the catalyst. But the UK is a great example of how you can get this wrong and how the bond market can force change. The bond market can shorten a career as a prime minister, and it can make you reverse policies very quickly. So what we got here is a zoom in to 2022. So you've got the 30-year bond yield lost 47% this year, and you've got inflation in the UK. So inflation tracks up Like you see in every bond market globally, the bond yields are starting to rise. So what led to the 30-year bond jumping from 1% to 5% in the matter of 10 months? So as you go along, you see inflation tracking up, the bond yields track up. But then somewhere in August, you take this big jump. So the UK 30-year bond yield was 0.5% on average below the US 30-year bond yield. Nothing different, same path. But somewhere the market starts to differentiate, and we think this is where the landscape is headed. The market starts to pay attention to policy. So at that point, and during the year, Andrew Bailey, Bank of England governor, signals consistent to the Fed, we need to tighten policy, 10 billion of bonds need to be matured every month. But at that point, Liz Truss walks in, and Liz Truss comes in with a pro-growth strategy, cut taxes, and the first thing she does is she puts an energy cap freeze, 150 billion pounds over 5 years. So every time someone in the UK has to pay more than 2,500 pounds a year, the government will sponsor the rest. This is an enormous amount. So she's stimulating the economy at the same time as Andrew's trying to tighten conditions because inflation's out of control. And what you get there is that the central bank then says, well, if you're going to stimulate, then the terminal rate, the rate that we're going to end up in policy rates, needs to be higher. It needs to be 5%. She then goes and they deliver the mini budget. They add another 141 billion in stimulus through tax cuts. That takes it to 291 billion over 5 years. Now, if you think about that, and it's an enormous amount, that's a lot of debt that the bond market needs to fund, and the bond market says not happening here. So bond yields in that month spiked 2.5%. And I saw an interesting tweet the other day saying, in the past, UK bond yields would be at 0.4, 0.5%. These days, they trade on a daily basis at 0.4, 0.5% up or down. And if you don't have a South African or Brazilian or a Turk in your team, you've got no chance of surviving because that is unusual for that type of market. So the bond market says no. What you then find is that you see risks lift from the surface. So the LDI market, pension fund market, comes unstuck. It's facing insolvency risk. The Bank of England has to come back and buy bonds after allowing bonds to mature. So the bond market forces then Liz Truss to step down. It also forces a reversal of policy. And these are the kind of things you see in emerging markets all the time. We don't typically see that there. But given all the debt that emerging or developed markets have amassed in recent years, we think the bond market is going to be much more alive to it. So in a world with structurally higher inflation, and we really believe that we are still early days in understanding how high inflation could be over the next few years, is yes, we may see a short-term roll-off, but we think structurally inflation is not going to get back to 2% for the developed markets. We think in that world, the bond market's going to play a much bigger role. It's the funder of this market. And here's a quote by James Carville, Bill Clinton's political advisor in the 90s, and he was just emphasizing how powerful the bond market can be. It can intimidate everyone. And we've seen the evidence this year. And as an emerging market, we've seen that for a very long time as it's forced our yields to very high levels. The second point that I want to leave you with before I hand over to Ané is that Bond Market 101 is in play now. The bond market is alive, and the developed markets are going to have to play by the same rules that emerging markets have played by. So the more debt you want to raise, the higher the cost, the higher the market's going to charge you for that, and the more debt you're going to have to raise inevitably to pay those higher interest bills. There are risks in the system in those developed markets, and we saw that this year, and we would be alert for stuff like this in the future, given when things unwind from such extreme levels, we wouldn't be surprised if you see more of that. But this chart over here is quite telling. Most of the debt from a debt to GDP perspective sits in the developed markets, but they've got the lowest interest bill. And lower debt sits in emerging markets, but they've got the highest interest bill. And this is where we think, for fundamental reasons, the market is going to start understanding that, especially when there's inflation in the system. So I'll hand over to Ané. She's going to talk about why we think that fundamental reason is developing right now.
Hi, everyone. Thank you so much for coming to listen to our message today, and thanks, Lyle, for that backdrop. So it's been a phenomenal 30-year bull run for developed market bonds, and it's been a decade of extreme monetary policy, and we're only today at the start of that unwinding. If we look out over the next decade, as Lyle mentioned, we think there are fundamental reasons why capital is going to shift from developed market bonds and search for yield elsewhere. Inflation in developed market bonds will be high for a while, and higher inflation and more inflation uncertainty is bad for bonds. It's particularly bad for bonds that are already expensive, like developed market bonds. But the same inflation that is hurting developed markets can actually be good for certain types of emerging markets, and we'll talk about that today. So bond yields, especially longer-term bond yields, have to protect investors against future inflation. Inflation has been above the Fed's 2% target since May 2021, and headline inflation has averaged closer to 8.3% this year. Yet, the market forecasts for inflation in places like the US, the UK, and the EU to drop all the way back down to 2.5% in less than 2 years. As you'll see from the quote on your screen, and that's from the head of macro strategy of one of the world's largest reinsurance companies, once inflation breaches that 8% level, historically, it's taken multiple years to get back below 2.5–2%. Inflation today is high, and it will take several years to reach back to central bank target levels. The developed market bond yields are not priced for this. They are priced for inflation to drop off to 2.5% in the next 2 years and back to 2% in 5 years' time. That means that developed market bonds are expensive today and will provide investors with negative real yields for a number of years. So as the economic outlook worsens in a lot of these developed market economies, we see an increased likelihood of deficit spending. Now, deficit spending is simply when government expenditure exceeds government revenue, and it's intentional spending, that's intentional excess spending that is intended to stimulate and grow the economy. So other than a growing economy, the voters in these developed markets want their governments to keep energy prices low. They want their governments to spend on defense. They want governments to reduce inequality and to fight climate change. And these are inflationary spending items. They also mean that budget deficits will widen and that more funding will have to be raised in order to fund these. Then secondly, many countries across the globe had trade deficits even before the pandemic. But high energy costs have meant that those trade deficits have been widening across developed markets, even in places like the UK, where exports have actually started to increase. And in the US, because of the very strong dollar that we've seen, you would think that in isolation, at least, that should make their imports cheaper. Yet we've seen a widening of trade deficits, predominantly because of energy prices, and that typically needs to be funded by foreign direct investment. So developed markets look to foreigners to fund their current account in this trade deficit. And when you combine these two deficits, the twin deficits, budget and trade, the fact that they are widening in developed markets is actually very relevant to emerging market investors. And we'll have a look as to why. Okay. So we're going to simplify the global flow of capital with an example, and we'll use the US and China as our first example. So China imports real economy assets from other emerging markets, and it uses those imports to produce products that it's been exporting to the rest of the world at very, very cheaply so, for multiple years. They then receive money for those exports, and the capital flows from, say, the US back into China. China uses some of those funds to sell the yuan, the local currency, and to buy US dollars and invest in some US treasuries. Now, that flow of capital has been mutually beneficial for a number of years. The US has a foreign funder for its current account and for its budget deficit. It's got a buyer of its bonds. And if you're China, they've been able to invest in very liquid US treasuries, which has provided them not only with a safe store of value, but it's also been a very effective way for them to keep their currency competitive. Now, up until very recently, treasuries have benefited from the Fed put, and so have other developed markets. So what the Fed put, or any central bank put, means is, as Lyle was explaining, central banks have been buying government bonds. And because of this guaranteed consistent buying, you had bond prices, as you saw in some of his earlier charts, that were just staying high and stably appreciating for multiple years. But as we know, that isn't the case anymore. US Treasuries were also not priced for high inflation because inflation has been incredibly benign, so it wasn't necessary. And then easy monetary policy for decades has meant that liquidity was pumped in the system, and there was a lot of liquidity to flow. So this flow of funds from emerging markets to developed markets and back can be replicated for any importing developed market and any exporting emerging market. So you can think of other commodity exporters, like, for example, Saudi Arabia, Taiwan, Russia. So geopolitics then comes to the fore. And geopolitics and inflation can actually break this flow. When investing in emerging markets, investors have an investment checklist that broadly asks, will I get repaid? Will I get my money back? Will there be liquidity in this investment? And will my capital be preserved? And then perhaps a fourth question, will inflation destroy my returns? This emerging market checklist has become very relevant to developed market investors this year. So earlier this year, the US, the UK, and the EU froze $600 billion of Russian foreign reserves. If you're China, and you saw the West just weaponize Russian foreign reserves, you may go back to that first question and ask, will I actually get repaid? Or will the US maybe frown on some neighborly disputes, say with Taiwan? It's very interesting to note that in the 8th month to August, China has been selling US treasuries for 6 of those 8 months. We've also mentioned that the Fed and other central banks are determined to reduce the size of their balance sheets. And the Fed is letting anywhere from $30 to $60 billion in US securities mature every month. So liquidity is also leaving the system. Then we get to that third question on capital appreciation. So the famous WIGBY that we all learned about 3 years ago, but for developed markets, the Developed Market World Government Bond Index is down 22% year to date. That's been disastrous for developed market bonds, as Lyle has shown. So investors should be questioning their prior assumptions on capital preservation. And as we've spoke about and will continue to chat about, their outlook for developed market inflation should also be revisited. So now we've gone through this EM checklist, and we see that it is very much a DM checklist today as well. And to Lyle's point, developed markets will have to start playing by the same rules as emerging markets. And that means that developed markets may not benefit from this global flow of capital the way that they have in the past. This matters to developed markets like the US, and that's because foreigners own 32% of US Treasury securities. China alone owns 4%, and that's almost $1 trillion US. We could see structurally lower demand for developed market bonds, both from central banks and from foreign investors, at the exact time that they actually need to be issuing more bonds and increase their borrowing requirements. And we can see evidence of gross issuance as increasing in places like the US. You can see gross issuance is still on an upward trajectory from pre-pandemic levels. And as we mentioned earlier, we think there is still a lot of fiscal spending and therefore fiscal borrowing to come. Attracting capital to developed markets will be more difficult in the future, definitely more difficult than it's been in the past decade. This is another investment checklist that you see on screen for fixed income investors, and it can probably be summarized as a developed market duration train wreck. There are challenges to the fiscal metrics in developed markets, and monetary policy credibility may also be questioned in the near future. So the Bank of England and both the ECB have been quite slow in raising interest rates. They've been late to that party. Yield curve control is still the mantra in Japan, and you see that central bank defend deeply negative real rates across their bond curves. And then as to the Fed, we think that the Fed will declare victory against the fight on inflation. As Lyle mentioned earlier, inflation will roll off, probably towards the end of next year, maybe in 2024. But we think it's then that the inflationary impulses from those fiscal spending measures will start to materialize. And you'll see services inflation, commodities inflation, energy inflation be a lot stickier than market participants are expecting today. Though the narrative on inflation is increasingly moving from team temporary to team permanent, we don't think the bond market has been pricing in this higher for longer inflation scenario. 2022 has also shown that developed market bond prices are far from stable, unlike we've seen in the last 30 years. And finally, the relentless strength of the dollar means that moving capital into that part of the market has quite a high hurdle today. But in the search for yield, there is an alternative. The same inflation that hurts developed market economies today can actually be beneficial to commodity exporting emerging markets. And we'll look at Brazil as a case study. Brazil's fate is export-driven. In 2008, 2009, it didn't avoid the global economic downturn, but it was amongst the last countries in and amongst one of the first countries out. And that's because Brazilian deep-sea oil fields came online, and it was exporting both minerals and food from its bountiful land to countries predominantly in Asia. In 2009, Brazil was forecast to be the 5th largest economy in the world by 2014, overtaking both France and the UK. In 2010, Brazil grew its real GDP by 7.5%. That's enormous. Then, 2 years later, in 2012, growth slumped to 0.9%. In 2012, we saw hundreds of thousands of Brazilians take to the street, and they were protesting the high cost of living, poor service delivery, a bloated state, and corruption in Dilma Rousseff's government. The same government where former president and now President-elect Lula was also implicated. Between 2014 and 2016, real GDP per capita declined by 9% in Brazil. Brazilians were getting noticeably poorer. In 2016, Brazil faced its worst recession since the 1930s, and Dilma Rousseff was impeached for budget tampering. Then in 2021, President Bolsonaro's government was criticized for its handling of the pandemic, and Brazil faced extreme weather conditions. They had both droughts and floods. So they saw food inflation materialize long before the rest of the world, but their central bank lacked credibility and struggled to rein in inflation. That economy was going one way, and that way was down. Brazil is a country that is endowed with abundant natural resources, from oil to agricultural products. 3 out of 5 glasses of orange juice drunk anywhere in the world was produced in Brazil, and oranges don't even make the top 10 exports of Brazil. But they've lost out on a decade of potential phenomenal economic growth. Why? Essentially because of poor politics. Now, I bet a lot of this is starting to sound very familiar. Yet, despite an inefficient state that is yet to deliver on structural reforms, a cyclical upswing in a lot of Brazil's main exports has meant that Brazil's economy went from being one on the brink in 2021 to proving to being much more resilient today. So we've mentioned Brazil as a key exporter of minerals and food, and you can see that iron ore and crude oil are also one of their top 10 export products. So after the 2020 pandemic slump, iron ore exports recovered by 73%. And that's not a small number, that's $45 billion of exports. And crude oil improved by 56%. Now that's great, but it was after a big slump in 2020. What's more important is that momentum has actually been maintained this year. When we saw data up to August this year, aggregate exports for Brazil were already up 20% versus the prior year. So consequently, revenue has been outperforming prior expectations, and Brazil's budget deficit has been declining. The budget deficit was nearly 14% in 2020, and by the end of 2021, that dropped to 4.2%. Now, expectations are softer for 2022, And that's because the market isn't giving the benefit of the doubt to the incoming administration. We don't know what President Lula will do in terms of the pace and scale of fiscal consolidation. That really does still remain uncertain. But for that uncertainty, investors into Brazilian bonds receive an uncertainty premium. It is currently and typically has been 8% above US Treasuries. Now you have to ask yourself, what is more risky? Investing in a developed market bond that is not priced for inflation uncertainty or fiscal policy uncertainty, or investing into an emerging market bond where that uncertainty premium is part of the package. Brazil is no longer a country on the brink. Strong commodity exports have led to a faster than previously expected recovery. Debt to GDP peaked at 90% in 2020, and it dropped to below 80% in less than 2 years. Again, debt to GDP is expected to rise gradually from 2023 onwards, because we and the market are not giving the new president the benefit of the doubt when it comes to implementing structural reforms and fiscal discipline. And again, that is okay. Foreigners don't invest in emerging markets expecting clean politics, and sweeping structural reforms. However, one major political reform that the Bolsonaro government did manage to get right was to give their central bank independence last year. Governors now serve a 4-year fixed term, and it doesn't coincide with the presidential election cycle. And we can actually see evidence of their independence last year as they started to hike rates very aggressively, and they returned to positive real interest rates much faster than the rest of the world. And positive real cash rates attract capital, especially if there aren't many real cash options around. Inflation is the single biggest driver of bond yields. And if you now, for the first time, have a credible central bank, which they're still building towards, but if you have a central bank that's actually focused on anchoring inflation, that can only be positive for investors into the Brazilian bond market. The trends that we've seen in Brazil has been in the opposite direction to those trends that we've seen in the developed world. Commodity inflation that is hurting developed markets has been very positive for Brazil's fiscal metrics. The real is still cheap. Bond yields carry a margin of safety through that uncertainty premium that we saw, and the scene has been set for the central bank to build monetary policy credibility. Markets have started paying attention to this. Brazilian bond yields have compressed by 2% this year, while developed market bond yields are 3 to 6% wider. The real, still cheap, is up 12% against a very strong dollar this year, and the Bovespa, the equity index, is up 10%. Brazil is starting to look quite attractive compared to developed markets. Now, let's turn to a commodity exporting emerging market that we know a lot better. We are very excited about the investment proposition in South African government bonds today. We believe that you can earn equity-like returns at bond levels of risk. So if you look at the South African All Bond Index, 2022 has been the anomaly. Bonds have averaged a return of more than 3% above inflation since 2016. Absolute returns this year are forecast to be -1% to -2%. The last time the ALB had a negative return was in 2015 because of Nenegate. And the subsequent years thereafter saw investors receive very good real returns. So we think this is actually a great starting point for investors. Revenue in South Africa is also outperforming prior estimates. And we now see a primary surplus for South Africa much faster than expected. This has been a key pillar in Brazil's turnaround. Our budget outlook has improved, but it carries risks. For those risks, there is margin of safety. Commodity prices are still high. Our growth expectations are not unreasonable. And at a peak gross debt to GDP in the low 70s, we have room to adjust. Reforms here are slow. They are too slow if you're a local. But if you're a foreigner looking into South Africa, again, that is okay. Emerging markets like us are priced for political uncertainty, for fiscal policy uncertainty, and for high debt burdens. Developed markets are not priced for the same risks that they do face today. Unlike Brazil, South Africa already has a globally recognized, credible central bank, and South Africa is a hike away from real cash rates. And importantly, South Africa's inflation profile looks quite different to the developed world. We don't face the same house and wage price pressures, and we produce a lot of the food that we consume locally. We and the market think that inflation has actually already peaked in South Africa, and that interest rates will peak next year, providing investors with attractive real cash rates. But if we look beyond cash rates, South African government bonds already provide investors with a real return that's above inflation of 4% at the 10-year point. Valuations are only second to Brazil, and they look vastly different to the rest of the world, where inflation is destroying any positive yield that you can earn on those bonds. Adding South Africa to our bond checklist, we look okay. In a world where fundamentals are shifting and bond markets are waking up, attracting capital to commodity exporting emerging markets is going to be easier than it has been in the past. As we said earlier, 32% of all US Treasury securities, and that's a $24 trillion market, is owned by foreigners. China owns 13% of the foreign holdings of US Treasuries. Just 0.5, half a percent of the foreign holders of US Treasuries equates to 15% of all South African government debt. If only the marginal investor, the marginal foreign investor, shifts capital from a developed market like the US into an emerging economy that's a commodity exporter like South Africa, the impact on our local bond market will be enormous. If I had to go back to our checklist and tie that to a product, to a fund, and ask you, will you get repaid from your investment? Will there be liquidity in your investment? Will your capital be preserved? And will you get a real return above inflation? I can answer yes by showing you the PSG Diversified Income Fund. And I'll hand back to Lyle to talk to you about this product.
Thank you, Ané. So I'll talk about the PSG Diversified Income Fund. It is our flagship fixed income fund, and it's really a product where we think if we are going into a multi-year opportunity in SA bonds, this is the one that I think can really deliver for clients. So best to start with what you should expect from the fund. It's an actively managed fixed income fund, flexible mandate, no strategic asset allocation, so we can use what we believe is the cheapest risk-adjusted opportunities in the market. And really in this product, we're not afraid to go where the yields are looking cheap and take risk for clients. But at the same time, in this product, we understand that capital preservation is a top priority. And particularly what's become more important in recent years is the ability to limit short-term drawdowns. So what we offer in this product is the ability to navigate high capital preservation, attack the cheap areas of the market, but then limit the likelihood of short-term drawdowns, that being rolling 3 months. What we do target in this fund is CPI plus 1. It's a unique benchmark, and we think it's quite relevant in the years ahead, just given our views on inflation. But through the cycle, given that we focus on buying cheap assets, construct portfolios by moving from the cheap areas of the market dynamically, asset allocating, we think we can do between CPI plus 1 to 3% when we show you how that's looked over time. So that's quite an attractive proposition. It means we can get you good income returns, but for those guys that are looking for just a little bit more than that, there's a bit of capital growth that can come through this portfolio. So typically in this space, guys will build the fixed income portfolio, they'll add property, it's very correlated to bonds. We apply the full toolkit available, so whether we be using preference shares, local or global property or equity, we'll do so cognizant of what we're trying to achieve in this mandate. So a very attractive proposition that over time has delivered quite well. So this is the 10-year track record up to September, and you can see a few things to point out over here that there's quite a big outperformance over that 10-year period over the peer group, but then significant outperformance of inflation. And most of you will know over this 10 years is that we've gone from a full interest rate cycle at the lows of 2012, the peaks of 2018, and then down to the lows of COVID. And this fund has really been tested, and it's sort of stood the test in our minds. But I'll pick out a few points over here, and really we focus on balancing risk and the opportunity set. And so clients want different things, inflation being our key driver over here. So from an inflation perspective, the fund has beat inflation 99% of the time over rolling 2-year periods, and it's delivered CPI plus 2.9% after fees. The fund is also then, for clients looking to beat cash, delivered 0.6% over the STEFI, which is cash plus a margin. And then for those looking for bond market participation, which we try to do when bond markets are very cheap, the fund has actually beaten the All Bond Index since 2014 when we established this process, albeit a small margin, at a third of the duration risk and a quarter of the volatility as measured by standard deviation. But we do this trying to manage the downside. And so we use all the asset classes available to us. It's a core fixed income portfolio. But from a downside perspective, the fund has never lost any permanent capital, no defaults, no African Bank, no Land Bank, no Steinhoff, and there are many other names that we avoided in the past. And then also, the fund has done this with a 92% success rate of positive months and a 97% success rate of positive rolling 3 months. So only 2 negative rolling 3 months, both during COVID, which were terrible months for the market. So we do that with downside protection top of mind. And we think in the context, this is a superior product in its space because we manage it having a flexible approach, buying cheap assets, ensuring a margin of safety. We've beaten the category 72% of the time with a 2.2% outperformance over 10 years. So we give the clients income returns, and when there's capital growth available, we will deliver that for clients as well. And the fund is really set up well for the future. So when we talk about the best ideas, top of the list for us is government bonds, fixed rate government bonds. The fund has a large exposure there, almost 30% in these bonds. So this is counter-cyclical investing, going where the market is fearing, and through that we're achieving attractive running yields alongside NCDs that are very, very attractive now. A short-term NCD, a 1-year note, is giving 8.5%, and the 5-year note's almost 10%. At very low levels of risk, being bank NCDs. What we also do is introduce inflation-linked bonds, so we're open to using different sides of the curves. We've got a small exposure there, but that will give us somewhere between 3 to 4% real above any prevailing inflation. And we see South Africa's inflation rolling, but this is protection in case we are wrong. We use preference shares. We've only got a little bit of exposure there. We actually loved this market in the past, and the yields that we are seeing there are somewhere between 9 and 10%. We wish we could get more exposure, but unfortunately it just isn't that liquid. And then through corporate bonds, I just want to emphasize one point is that typically in our space, you'll see a lot of corporate bonds in most income funds. We've probably got the least exposure in the category in that space. And this is just all about protecting investors against that downside risk where we think that's where the market is probably getting it wrong. And then we'll use offshore as a mitigant, direct cash or offshore bonds, and that's an area that we're quite excited about because offshore bonds are starting to lift, particularly on the front end. Now you'll pick out that cash line over there. We've got almost 12% in cash, and you'll be wondering why would we keep this when we've got yields all over the place looking really good. And that's really just trying to keep the client's risk appetite in mind and then be tactical in a volatile market. And if we take that 11% cash or 12% cash, we can adjust that running yield from 8.9% to 10% easily, just buying very low risk instruments. So what we see going forward is the running yield lifting, but we've got firepower that we think the market doesn't have, and Ané pointed out liquidity matters quite a bit to us. So the last part I'll touch on is really a key differentiator, is in our space, guys use property, and we think it's probably one of the worst ideas that you can use in isolation alongside a fixed income portfolio. So what we do is we use the full buy list at PSG Asset Management, and it's really been a great differentiator over time of real returns, cheap ideas that have different risk and return drivers to your fixed income market. And with a small exposure of 4.1% today, we think we can add a lot of value over time. The expected returns from this market, even over an extended period of 5 years, can do really well for this portfolio. But obviously, that's a lot of talk, and I think most want to understand what they can look forward to over the next 12 months. So the running yield at the center is, if nothing happens and the bond market stays where it is, the fund will do around 8.9%. That's given, it's low risk. We understand that that's what you'll earn from the bond market. If you move to the left-hand side of the chart, that's essentially the bond market getting worse and worse, yields rising and you're losing capital. Over 12 months, we expect, even in a tough scenario of yields going through COVID levels, you'll do roughly around cash, which we think is quite an attractive proposition. And then to the right-hand side, we think the bond market is at least 1% too high now. And in that scenario, the fund's going to do in excess of 11%. And we think buying these cheap securities and constructing the portfolio with downside risk at mind, we've created an asymmetrical profile for clients over the next 12 months. So we're very excited. We think it can fulfill that income gap as well as contribute higher up the curve where guys are looking for CPI plus returns. So to conclude the presentation, there is a fundamental reason to look for yield elsewhere. We think it's been a tough year for fixed income in SA. We were happy to sort of stay in the position where we kept clients alive, but we think this lays the foundation for many successful years ahead. As we saw in 2015, beyond that, there were great returns for fixed income investors, and inflation is going to be a tailwind for South Africa and commodity exporting EMs. Our bonds are super cheap, 11.5% yields, all the way from 10 years out, and we think that will deliver equity-like returns with 11.5 already banked today because you will receive the coupon. And then our fund, we're utilizing the opportunity. We've got a long-term track record of outperformance. And we think consistent with mandate is you want to attract, you want to use this opportunity, then balance risk at the same time, and we are acting consistently and reliably. And I'll just leave this slide up over here. I think this is backed by our award-winning process and team. Our income fund took the 5-year raging bull for risk-adjusted returns, and we think through the Diversified Income Fund and this product, we offer a very good proposition to clients. So I'll close off there. Thank you to everybody for attending today. It's really great to see you in person. And thank you to those online. We'll be around if there are any questions. Thank you very much.